Every time you go to a new restaurant to eat, you look at the wall and look for a sign that says it is being certified and it is safe to eat. Similarly, in Wall Street and Dalal Street too, there is a certification that takes place for the securitization of bonds. What are the similarities and differences? Stay tuned. Imagine a giant kitchen where a master chef is preparing thousands of meals every day. Each dish is different. Some are simple street snacks, some are luxury desserts, some are family meals. Each has its own mix of ingredients, spice levels, and complexity. Now, before these meals are served to guests, a food inspector steps in. They don't just taste one dish, they inspect the hygiene, the freshness of ingredients, how the kitchen handles safety standards, and even whether the chef's team follows constant recipes, consistency. In the world of finance, those dishes are loans, and the food inspector is the credit rating agency. Some loans come from salaried government employees, others from private sector workers or small business owners. Some are for compact apartments, others for luxury condos or commercial projects. Each loan recipe has its own flavor and risk. Before these loans can be packaged and served as bonds to investors, the credit inspector certifies them, rating their quality, texture, and consistency. That certification tells investors this loan pool is safe to invest and consume. Table captures from where these bonds are originated, whether it is housing finance companies or fintech, NBFCs, and who are the typical customers that buy them. It can be hedge funds, it can be a part of money market funds, it could be a part of pension funds, etc. You have higher ratings like AAA and AA, which means it has lower yield and the demand by the investors are quite high because they are assumed to be safe. Once these loans are certified, rated, and packed, they so-called leave the kitchen. In the United States, these certified loans are shipped around the world. Investors from Tokyo to London buy them, and they even get pledged in international repo markets when they are AAA rated, where they are used as a collateral to raise short-term funds. In India, these securitized loan bonds are usually stay within the country's borders. They are traded locally, mostly between banks, mutual funds, and insurance companies, inside India's own repo market, but it is also regulated by the RBI. In United States, the credit rating agencies are usually Moody's, S&P, Fitch, DBRS Morningstar, Kroll Bond, and in India, you have CRISIL, ICRA, CARE, India Rating and Research, which is a part of the Fitch Group, and Brickwork Ratings. The bonds that are getting created by securitized loans by United States is exported, its underlying currency is USD, and hence the systemic risk is high. In India, the securitized bonds are in INR denomination, and the consumption is domestic within India, and it is hence RBI regulated. Once the special purpose vehicle issues these bonds, auto loan MBS or any other MBS, become treated as tradable securities. So, to the financial system, they now look a lot like high quality collateral the moment the credit agencies give them AAA, which means it is no different from corporate bonds or even government debt. This way, they have an entry into the repo market. One can pledge them to the repo market, borrow short-term cash, use these securities as collateral for loan for 1 to 7 days. When a loan pool is first securitized, the credit rating agency performs a deep one-time assessment. It examines borrower credit scores, repayment history, and loan-to-value ratios. They test the structure of the special purpose vehicle, how much credit enhancement, cash reserve over collateralization is built in. It assigns an initial rating, AAA, AA, etc. to each bond tranche. That rating reflects the expected performance at that moment. It is like a food inspector's initial certification before the dishes leave the kitchen. After issuance, there is periodic monitoring, but not resampling. which means after the bonds are sold, the rating agency does ongoing surveillance but not full resampling of every loan. They receive monthly or quarterly reports from the servicer showing repayment rates, delinquencies, and defaults. If performance worsens, the credit rating agency might revise the rating, downgrade, or rarely even upgrade. However, they don't re-inspect every individual loan. It's more like checking delivery logs rather than retasting every meal. So, the overall process between the food rating agency and the credit rating agency is similar. One deep inspection, periodic health checks, reactive downgrades if things well off. Hence, ratings can stay high after loan quality starts slipping because agencies wait for confirmed data before changing their rating opinion. This lag means investors might still believe the earlier rating as valid and hence start buying and investing based on that opinion. The agencies, however, defend themselves, the credit rating agencies, by saying that these ratings are opinions and hence not guarantees.
Now imagine this. A few clever restaurant chains choose to create a package of a collection of dishes, and a few dishes are going to go stale. The food inspectors are not going to sample your food every night. And the problem with this packaging is that the certain parts of the food is still fresh. So the complex food package is appearing to be safe to eat. But it is only a question of time where people realize that this can actually be the cause of food poisoning. In the next video, we will look at one such incident that happened in Wall Street in 2008 that really shook the entire financial market. Stay tuned.